The second topic that we're going to talk about is continuing and discontinued operations. Continuing operations is the net income category in the income statement that accounts for a company's daily business activities, referring to the task required to make a product or service and deliver it to a customer. A discontinued operation occurs when a segment or certain product line in a company's business has been sold, disposed, or abandoned and is subsequently reported on the company's income statement as income separate from continued operations. This is reported on the income statement of a business. First, continuing operations are distinguished from discontinued operations. Although the component is being disposed of, the company had the potential to incur a gain or loss in the current reporting period. Therefore, both the pre-tax and after-tax earnings are reported. Next, discontinued operations are reported. The total gain or loss from the discontinued operations is reported, followed by the relevant income taxes. The income tax is often a future tax benefit, as discontinued operations tend to result in losses. The gain or loss on discontinued operations is aggregated with the result of continuing operations to determine total company net income.
Continuing and discontinued operations are used on the income statement because income from continuing operations are products and services that the corporation will continue to provide. But discontinued operations are products and services that the corporation received income from, but will no longer provide. Both these are shown on the income statement, and they are separated because it can provide a better picture of how the corporation is making income and where their income is coming from. For example, if both continuing and discontinued operations are put together, and you get a certain income figure for a certain year, but next year your income figure could be lower, it could be hard to determine why the income figure decreased. It could be because the year before we included income from a product or service that is no longer being sold. Under IFRS, components like a separate major line of business or geographical area of operations or a business qualifying as held for sale upon acquisition can be disclosed. Under ASPE, components like an operating segment, reporting unit, subsidiary, asset group, or operations without assets can be disclosed. IFRS is more restrictive than ASPE, because under IFRS, bigger operations can be disclosed.
Alright, let's do a few examples. Company XYZ has a fiscal period of 12 months and provides one of its services for 6 months only. But in their income statement, they did not separate their discontinued operations from their continued operations and stated that the service was provided for the entire fiscal period. What is the problem with this scenario, and is it an ethical move for the company? The problem with this scenario is that they are not showing that the service was only provided for 6 months and not for the whole fiscal period, which means that they are saying that our service is continued, but in reality it is discontinued. The company's income might decrease for the next fiscal period since they're overstating their income by 6 months for this fiscal period. Also, this is not ethical because this will not show the shareholders the actual amount of income that the company has actually generated during the fiscal period and how they generated that amount. Okay, let's do another example. Look at the given income statement and state all the errors and explain. After looking at this income statement, we can tell that the heading should say income statement instead of balance sheet. Profit before income tax should be subtracted and not added. It should be profit from continuing operations, not loss. It should be loss from RT manufacturing because it's under discontinuing operations and means that we no longer provide the product. It should be loss on disposal instead of profit. And finally, the amount of profit should have a dollar sign in front, and it should also be underlined since it's the very last number that we're gonna write.
Would you add or subtract the value of discontinued operations before or after operating expenses? You would add or subtract the value of discontinued operations after operating expenses because operating expenses affects the operating income. Discontinued operations would affect the income from continuing operations because discontinued operations either adds value to the income or takes away value from the income. And it would be helpful to viewers to make this change to the income after finding the income from continuing operations because the income from continuing operations is the income from products or services we are still selling. What is the difference between income from continuing operations and income from discontinued operations? The income from continuing operations is income that is made from products or services that are currently being sold. Income from discontinued operations is income from products or services the company no longer sells.